Alongside me, Julia Lee from Bell Direct. Julia, thanks very much for your time. As the market opens, what are you expecting through the session today?
Look, I don't think we're going to see a massive impact in terms of the budget, but plenty of company news about. We've seen that update coming through from Commonwealth Bank. And I guess one of the implications of the budget is to life insurance, and Commonwealth Bank will be pretty pleased to have sold off its life insurance unit ahead of that budget announcement, which is bad news for some of those insurance companies. But altogether, we've got another update from CSR, Incitec Pivot, a profit downgrade from Green Cross. We've got Goodman Group due out with some numbers, and Xero due out with some numbers as well. So it looks like it is going to be a busy day for the Aussie share market, and maybe a little bit of a lift from some of those consumer-related stocks, although, you know, a 7-year plan is a pretty long time for all those tax cuts to come through.
Absolutely. Look, your thought though on CBA, how it's travelling?
Look, overnight we saw financials higher, but it looks like Commonwealth Bank will come under pressure on the back of this update today. And I guess in terms of the bank, you look at mainly two things. One is revenue and the other is expenses. And in this particular update, Commonwealth Bank said operating revenue is under pressure, and expenses are going up because, of course, of compliance and regulatory costs as well. So I guess that combination, not a very positive one for Commonwealth Bank in terms of the markets. So it looks like it might buck that positive trend we've seen from offshore.
CBA, it has. It's just come online. The stock's opened up down 2.25%.
I mean, I've spoken about Green Cross and some of the other models on the market where you're relying on sort of acquisition growth, or you see a competing ASX listed vehicle coming on. And if you have a look at Green Cross, it reached an all-time record high back in August 2014. And that was just before National Veterinary Care came onto the market a year later in August 2015. Now, since National Vet has come onto the market, we've actually seen Green Cross shares down 12%, not including the fall today, but National Veterinary has gone the other way, up by 77%. And look, that's similar to some of the other models. For example, G8 Education is another one that comes to mind, reached an all-time high back in September 2014. Think came on in October 2014. Of course, G8 hasn't seen a record since then, and G8 Education's down 52% since then, and Think's up 50%. And you can say the same for InvoCare and Propel Funeral Services as well.
So that's the key when looking at roll-ups. Yes, you can get some good early momentum, but as soon as there's a competitor in the market, get out?
I think so, and in conjunction with the rising interest rate environment, it just makes it a more difficult model. So I guess the roll-up mentality is that businesses that aren't listed on the ASX trade at a discount to ones that are listed on the ASX. But as soon as you have another competitor which is competing for acquisitions as well, you find that the prices of these assets slowly start to creep up, and it becomes harder to grow by acquisitions, and then the rising interest rate.